I request everyone to mute themselves because I am going to make a co-host. Only the co-host can be able to unmute themselves. So speakers and moderators as well as president, secretary will be the people who will be able to speak. Otherwise, disturbances
Yes,
can cause the
yes.
problem here.
Agreed, agreed.
Already it is streaming on live on the YouTube.
Yeah, yeah.
Let me complete the formalities of making everybody a co-host who is going to present.
Dr.
Vijay
Khurana has joined. Dr. Vijay Khurana, sir.
Yes, I'm here.
Yeah, please
Hello.
make him a
Yes,
co-host
I'm here.
also. Dr. Vijay Khurana.
Yeah,
Yes,
made
sir.
him
I'm here.
and
2 minutes just. At now 2 minutes.
so
Yeah.
only the speakers be able to unmute themselves. I'm muting everyone.
Yeah.
So speakers can unmute themselves who are host. They can share also.
Right.
30, open your limb.
Now, so welcome to this a very special ISA Financial Advisor webinar, and we have got the best of the three speakers who are going to know how to go rich in your life with the money and the health and everything, and very apt topics are there. I think everybody logging in before time. We have never seen such a response in any of the webinars, be it a class, be it a practitioner forum, be it anything. But everybody is, very much enthusiastic about this financial webinar. So I request Dr. Bala Venkat, sir, to start the proceedings from here.
Thank you so much, Honorary Secretary Dr. Sukhminderjit Singh Bajwa. At the outset, I would like to extend my sincere thanks to our Vice President, Dr. Virendra Sharma, who has been the cornerstone on whom thought this webinar unfolded. And I'm extremely happy that we have three experts who are going to guide each one of us on the way we need to live. If the professional life has to become excellent, it is becoming important to have a personal life very stable. And for the personal life to be stable, it's important that we manage our finances very well. So it's very important that as a professional and as a doctor, the minute you enter the medical school, we kind of become very myopic and our focus and concentration are purely academic. So I think sessions like this are very crucial and important in the well-being of our professional colleagues who can make themselves acclimatized to the new environment that has been created by an surge what is happening economically in a country, and also to wisely invest and make sure that from all that earnings we have, we make the best out of it. And we need assistance for this. And I'm extremely happy that on a Sunday afternoon, so many of you have logged in, which have clearly indicates that this is an important component of our life. And I don't want to take much of your time. I'm taking this opportunity to wishing you all a very happy new year and a year in which you're going to become richer with all that we earn. And to guide us, we have three experts. Over to you, Dr. Bajwa, and thanks to all the experts for accepting to share their precious Sunday afternoon time with all of us here. Thank you so much.
Thank you, sir. Such an enlightening speech, a short and sweet speech, I know. And Dr. Bala Venkat sir said, I will try to get all the advices properly later on individually also to get richer. So I think we should not waste time. And I like Dr. Virendra Sharma sir also to say a few words before we really start with the first speech. Dr. Virendra Sharma.
Thank you, Dr. Bajwa. Respected President, sir. Members from the Governing Council and experts, my dear colleagues. This is in continuation with the series of webinars which we have been organizing for our members in financial update. Recently, every 6 months, I try to do a poll in those groups. And what is happening is that with time, more and more newer members are joining. And then it becomes more of a duty for us to, again, because these topics about mutual funds we have been discussing since a long time. But still, there are many things which need to be told, which need to be informed. And the topics today are very simple. Still, they need a lot of introspection, lot of knowledge, because invariably you all ask a direct question, please tell us in which mutual fund to invest. That is not the purpose for the which the group is created or awareness. Our purpose is to make you self-competent so that you can decide. It's your money, where to invest, and how to take that out. Now, this SWP is very important, and that's why Dr. Kumresh has chosen that topic. Once you create a corpus, now what to do? That is the next step. And one more thing, luckily, since now it is 8th year going on, we wanted the members to experience the market fall and upgoing, because that is what we have been saying. When you invest, please make sure you invest for a minimum length of time. Don't keep in mind short targets that in 1 or 2 years you will gain this much or that much, because that is not in our hands. But if you invest for a little longer time, definitely you are going to get good returns. And reasonable returns we talk about, we never tell about exaggerated returns. So to tell you all about this, first, Dr. Gajjar will speak about investment, that is SIP, Systemic Investment Plan. And in continuation of that, when you create a corpus, then Dr. Kumresh will guide you how to do a SWP, Systemic Withdrawal Plan. So over to you, Dr. Gajjar, sir. You can start sharing your screen.
I can start the screen.
Sorry, 1 second. Dr. Bajwa, you want to say something?
No, nothing. I think you have said almost everything. I think I was just skeptical how to take the sequence wise. I think it's right. Dr. Rajnikant Gajar first, then Dr. Kumresh, and Dr. Khurana sir afterwards. I think that's the sequence of the lecture should be like. So Rajnikant sir, you can start sharing your screen.
Is my screen visible, sir?
Sir, it will come. I think it's taking some time. It will come. I'm just monitoring it. Sometimes due to network, it takes time. Or you can stop sharing and start sharing again, sir. It will come. I think some technical part is there left.
Stop sharing. I'll share.
And yeah, you share it again.
There appears to be some issue. My screen is not being shared.
Sir, you have a PPT now along with you.
Yes, yes.
Sir, you just mail it to me. I am putting my email address here so that I can share from my side. The problem keep on persisting.
Okay, okay.
Sir, you just send the PPT to my mail.
Will you share me your email ID on WhatsApp or?
Sir, I'm sending, sir.
Okay.
In the chat box, you can just, I'm just typing it. Gmail, read it as gmail.com, not mail.com.
I'll stop the share.
Just send me the thing. Dr. Virender, shall we start with the Kumaresh sir?
Yeah, then we will do one thing.
Hmm.
We'll ask Dr. Khurana sir to share his experience for 10-15 minutes because I want SWP after SIP.
I think that's a perfect order. So, Khurana sir, are you ready for the sharing the screen?
He doesn't have PPT. He'll speak, share his experience of a long journey of
Okay,
35, 40 years.
fine. Then it's fine.
Yeah. Can you hear me?
Yeah, sir.
Yes.
Yeah.
Am I audible?
Yeah, sir.
Yes,
Audible.
yes.
Yeah. Okay. First of all, thank you, Dr. Bajwa, and thank you, Dr. Virender, and good afternoon, all friends. I really feel honored to share the stage with Dr. Gajjar and Dr. Kumresh, who are really financial experts. First, a disclaimer. I am no financial expert. I have no financial training. I learned by my mistakes. I committed a lot of mistakes, probably more mistakes than the right decisions. Because, I mean, like, I come from a very, humble family, low middle class family. During senior residency, it all started just like everybody else. Started investing for the purpose of tax saving, national saving certificates, LIC policies, and things like that. This is mid 80s. I can divide my journey in four parts: 80s, 90s, 2010s, and later on. So during the 80s, and I was doing my senior residency. So started with usual stuff for tax saving. And then end of the 80s, I started my practice. And that was when stock markets were booming, started booming, that's the meta time. And everybody got interested into market, so did I. And we had a small group in hospital who were very interested, who used to read and thought they were experts, started dabbling in stocks, opened their PPF account, and then started buying stocks on tips in secondary market as well as in IPOs. There was an IPO boom, and IPOs primarily were regulated by CCI, Controller of Capital Issues. They used to fix the price. And if you got good allotment in IPOs, they were just like a lottery. But there were also lots of fly-by-night operators. There were all kind of things. So I started dabbling in stocks, IPOs, and mutual funds. Mutual funds are primarily closed-ended funds, and they were not very transparent. There was no SEBI. SEBI came into mid 90s, I think. SEBI from somewhere around 1993. So they were very poorly regulated, and they were closed-ended funds, and maybe was never disclosed. So I started dabbling in everything: stocks, secondary market, primary market, uh, insurance policies, real estate, everything. So that's how my journey started. And this can, but then a fiasco happened with me. An LIC agent missold me some product. I'll not go into the details. What was the product? Although I didn't lose anything, and the that fellow cheated many doctors, and eventually he disappeared one fine day. When he disappeared, I mean, it was a big shock for me. I took out all my documents, policy documents, read the fine print, and I was really aghast. The policies, they were heavily favored towards the agent and absolutely against the customers. That was when I decided to, get educated. I surrendered the policies which had just begun and let continue which were nearing their term. And then I started reading. I subscribed to various newspapers: Economic Times, Business Today, Capital Markets, The Lal Street. I started following Dhirendra Kumar, Sucheta Dalal, Swaminathan Ankleshwariya here, who was editor of Economic Times at the time. He used to write every Sunday in Times of India as well. So I started reading those articles. I started generally reading. Before that, earlier to this, finance was absolutely Greek to me. We used to skip those last three pages of finance papers where they used to publish their daily stock prices. It was all Greek to me. But this is the time I started educating myself. I started subscribing to these magazines, started reading about economies, how it works, what are the ropes. But still, my investments were haphazard. When I used to buy anything. This continued till in the 90s. Then I opened a demat account in 98 or something like that. But still, my investments were in total disarray. Those were the times of physical certificates. And then in 94 and 92, 93, when Harshad Mehra scam happened, that group of the hospital doctors who used to, like, take pride that they have made so much of money. I also lost, obviously. The index tanked from 4,000 to 1,000, and there was a big loss. So I just stuck my certificates into a suitcase and dumped them. See whatever happens. If I lost 80%, the maximum loss is again 20% rest of it. So I let it be there. But all through this, I had one thing. I still had faith in the capital markets that they will give good returns. And finally, there was a friend of mine who started doing financial. He was took mutual fund agency. I talked to him and consolidated everything. Sold real estate. I didn't. Really earn anything from real estate also. All the LIC policies, mutual fund stocks. I sold in somewhere in I think 2003 or 4. Consolidated everything, organized my portfolio, and I sold stocks to the tune of my original investment. I was losing only the interest part from mid 90s to 2003 and 4. So the original investment part I sold and thought that by rest of the stocks are zero cost, uh, apart from the interest cost. That's how and 2003 I started really doing seriously in mutual funds journey. But even then, I committed a lot of mistakes. Like, I didn't know, what various kind of funds. The number of funds became too many. I didn't realize that I'm buying too many funds. But anyway, they were giving me good returns, and I bought a few funds in my wife's name, my daughter's name, which had no advantage at all because there was no capital gains. So that is a mistake I committed. I bought in my daughter's name, my wife's name. Eventually, when one of my daughters settled in the USA, and I had a lot of problems. I had really more than one CR in her name. Last year I liquidated them finally, and still the tax had been deducted. I still have to claim it back. I have stocks which I now plan to give to my daughters. So also, whatever happened, I committed a lot of mistakes. Finally, I learned lessons and made my own do's and don'ts, what to do, what not to do. And one thing was, my strength was that I had a lot of patience. I never faltered, never stopped my investments. Even in 2008, when the markets crashed, subprime crisis happened, I still invested. I even invested yesterday also. Put a lot of money yesterday also. Whenever I have money, initially I started with STPs. Now I put lump sum. Whenever I have any extra amount, I put them in the market, in my existing mutual funds. Then I started reducing the number of funds I have. But there's still too many because if I switch, there's a lot of capital gains involved if I sell them now. But all said and through, I am happy with my eventual outcome of the journey. I have, I don't claim to be an expert or anything, but I have my principles now. I shut external noise. I don't listen to anything. All through, no my all investments are in financial instruments. That's one thing. I have sold off all properties which I ever had in 90s. everything else. I only have stocks, mutual funds, and a PPF account, which is now 35 years old. So I'm going to close this PPF account also in this March, and gifting my stocks to my daughters, and I'll be left with only mutual funds, which is a substantial sum for my retirement. More than that, I still hold nearly 65% in equity, 35% in debt mutual funds. In those debt mutual funds will last me my retirement. More than that, my retirement fund, considering maybe I'm nudging 70 now, so maybe another 20 years, then only debt funds will last me my lifetime. So not necessarily that I should have more debt. Uh, I'll be left with equity, which I may pass on to the next generation. That's how. And uh, my basic strengths were have faith in the market, stay invested, and step to the external noise. I carried it through the period. Saw all kind of, I mean, crashes, subprime crisis, failures, Trent Harshad Mehta, everything. And I kept investing all through. That was the biggest strength of mine. I kept investing and I had patience. I didn't listen to anything else. There are a lot of stories going around. You sit around with doctors, most of them, yeah, property lady, this and that, and this property is worth this now. I just don't listen to anything. I stuck to my basics, and thankfully, matlab, I have enough money with me. Returns are pretty good, satisfactory. Matlab, there's no, I mean, like criteria which is good or which is bad. It is beating inflation, and for me, the biggest multiplier in markets is the time. You may commit mistakes. I did. I committed many mistakes. But the biggest mistake in investing is not staying in the market in long term. One has to have patience, stay long term. That is the biggest multiplier. And of course, you have to choose good funds and take right decisions. But I think even if you falter there, if you stay invested long term, even if I mean like you fixed instruments, you still make a lot of money. So my takeaway is start early, stay invested all the time, diversify your funds, make your own strategies, do's and don'ts. Don't listen to external noise. Diversify, but do not diversify overly. Don't over diversify. Do asset balancing. Avoid non-financial assets. Invest in funds which you can control, which you can liquidate immediately, which you are under your control. So I'm dead against real estate, not even gold. So that's all. I mean, like, it's a short journey. I'll happy to answer anything if I mean like it's a short one. I might have missed many things, maybe. So that's a brief journey.
Thank you, Khurana ji. The one point which I want to tell all the members is, because I personally know him since 2017, being totally into private sector, no
Yes.
pension, no government job, still
Yes,
his
sir.
commitment,
No inheritance. No, I have not
no
inherited
inheritance
anything.
from a very humble family, but still since 80s, who has seen all the crises. What happens is when there is a stock market crash, the normal feeling is collect whatever is left and run away. He still persisted, and he is an example for all of us. He is not a financial expert. He has never taken any degree or something. He read by himself, got knowledge from expert. So what the message is that any one of us, if we have faith in the equity market and we have perseverance, we can continue investing for long. And the main thing is what he said, when there was a crash, everybody is running. He invested whatever was there. He sold his real assets and invested. And that is how you make big money. I mean, that nobody can deny the fact that that is the usual procedure, but we are all human beings. We get carried away with whatever colleagues say.
Yeah, person does get to panic. When Harshad Mehta crash happened, we had a group of doctors who were really big time into stock market. One of them, in fact, became a sub broker also. I used to apply IPOs through him, and most of them, they said, we are done with it. We will never enter the market again. Itne losses ho gaye, we are not coming back again. I thought, okay, if I lost 80%, I might lose another 20%, but I persisted with them. In fact, I kept buying, and another thing, where one big mistake I did was in 2003 when I started my real journey into mutual funds. I sold my stocks. Sold the original value. If that's the biggest mistake I ever did, and retrospectively, I think that was the mistake I did. I sold my stocks. If I had not sold them, they would have been at least 50x of the value at which I sold them. 50x minimum, not counting the dividends. So that was one mistake I committed in my. After that, I have never sold my stocks. Of course, the stocks initially I had, some of them became duds, but some of them were so good to me. I have a 10,000 bagger with me, 3,000 bagger with me in my portfolio, 3,000, 4,000 bagger. And I have 100 baggers, 200 baggers, 500 baggers kind of stocks. So the only regret I have is why did I sold those stocks, which I did in 2003? They would have been 50x by now.
Right, sir. So you continue with us. We'll have the question answers at the end. So, Dr. Bajwa,
Yeah,
sir,
sure.
can you share
Yeah,
the?
I'm just going to share, but just one thing very well said by Dr. Khurana sir about the thing of retiring, and I am thinking of retiring another 2 years because I am also been into the equity with from 2002, and I think I've already planned my retirement from 55 year onwards. People may retire at 70, may
I'm
75.
also uh, I'm also kind of semi-retired. I work just to go out of the home, and might work for another couple of years maybe. And let's see.
Yeah. So Dr. Rajinikanth is trying to share the screen. If it's not possible, then I will share.
Okay, okay. I'll just wait for 5 minutes. If it can be done, it's okay. Otherwise, we'll start. I think it's not working, so let me stop the slide.
Yeah, it's the same thing coming. Yeah.
Visible, sir?
Yes, yes.
Yes, yes.
You
It's
just
okay.
keep telling me. I will keep forwarding the things.
Okay, okay, okay. Respected dignitaries, respected ISA office bearers, and my dear fellow anesthesia colleagues, my presentation is titled as Strategic SIP, Simple and Successful. Next. Details about me. I am very much sure that most of my anesthesia colleagues do have basic understanding about the SIP. Not only that, many of them may be having ongoing continuing SIP as well. But the purpose of the presentation today is to share with you the advanced understanding about the SIP. That is SIP with strategy. That is strategic SIP. I write on my blog on personal finance that is titled as rkhgajjar.wordpress.com. I have no advisory or business or commercial or professional interests involved with this blog. This blog is totally free to me and totally free to you as well. Next. SIP is basically a method of investment in a systematic way. It is a vehicle to reach the destination of a particular financial goal. It itself is not a mutual fund scheme. It is simply a mode or a medium of investment. There can be a non-systematic investment way also. It is also called as lump sum investments. But herein one invests as per one's whims and fancies. While systematic investment has sets of rules, the amount is fixed, the date is fixed, and the asset class is fixed. Strategic SIP is an SIP with strategy. It is a step forward in the SIP management in the journey to the wealth creation. Next. The strategy rule is 7-6-5-4-3-2-1-0 rule. Each digit, each number has significance and relevance. I'll explain the same in the following slides. What is SIP and why it is necessary is not the subject matter today, but how it is to be executed is the subject matter today. I'll not answer what is SIP or why it is necessary, but I'll explain how it is to be executed so as to make it simple and successful. Systematic investment planning is a better investment planning because it eliminates the impulsive actions. It becomes based when it is done with a strategy, that is strategic SIP. Next. The first digit 7 stands for SIP always means 7 years duration, like pregnancy always means 9 months. Because the duration of 7 years is a good enough time for all the bull and the bear phases experiences in the capital markets. It is also good for appreciating the compounding benefits and also appreciating the rupee cost averaging benefits in SIP managements. But it may differ also as per the timeline of the goal. Say for retirements, the duration can be in the decades, say 10, 20 or 25 years. While for the emergency funds creations, it can be shorter also, say 12, 24 or 30 months only to create the corpus. Next. 6 stands for the most 6 important words in the personal finance. They are goal-based investing are the first 3 ones and the asset allocation strategy are the next 3 ones. I have elaborated this in one of my blog posts. Do refer it. The blog is titled as 2 most important but very simple concepts in personal finance for financial independence. Dear colleagues, to appreciate, to understand, and to execute these 2 concepts, that is the goal-based investing and the asset allocation strategy, is crucial and compulsory if one has a desire to reach the stage of financial independence sooner or later in their lives. It is very crucial to understand goal-based investing and assets allocation strategy. Next. 5 stands for we all of us do have at least minimum 5 personal financial goals. So our SIPs should be restricted to 5 SIPs, not more than that. I have listed all the personal financial goals in their order of priority in my understanding as follows. The first is the emergency funds, next is the retirement funds, third is the kids education funds, fourth is the most important personal financial goal in our ongoing life, that is to build and accumulate the assets and to have the experiences in our ongoing life. And the last is the kids marriage funds. In my opinion, kids marriage are a shared responsibility, so they are last in my priority. Whenever we start any SIP, an SIP has its life of its own also. The first is the conception. That is, before you start an SIP, we must always fix the goal, set the goal. That is the first. Next is start. That is the action. Third is stay focused. Whatever may be the fluctuations in the capital markets, it may move anywhere, but you stay focused with your SIP and the goal associated with the particular SIP. Stop at success. SIP stops only when we reach the goal deadline, either in the form of the timeline or in the form of the goal corpus size. Stop at success. There are 3 golden rules in the SIP management. For this presentation, I have studied SIP in detail. There are a number of varieties and the flavors about the SIP, namely perpetual SIP, daily SIP, weekly SIP, fortnightly SIP, quarterly SIP, value SIP, trigger SIP, flexi SIP, SIP with insurance, multi SIP. But dear colleagues, all these varieties and the flavors are marketing gimmicks. What is basically required is simple monthly regular SIP. That is all. Similarly, there are a number of studies done to find out which date is the most beneficial for the SIP management. But here also the studies have proved that any date is good date. Let it be close to your salary or let it be close to your income flow. The more convenient to you it is, better it is. But the most important rule in the SIP management is always step up your SIPs at the rate of 6 to 10% year on year. This is the most crucial for the success of the strategic SIP, that is step up SIP. 2 stands for 2 reasons. Whenever you pursue a particular financial goal at one stage in later years, the goal corpus size may become huge enough. So this is a time or a period when we should diversify across the 2 asset management companies so as to reduce the concentration risk associated with a single asset management company. The other reason 2 stands for is we must always differentiate our all personal financial goals into 2 classes, either non-negotiable classes or negotiable classes. Non-negotiable goals are such that when the goal deadline is reached in the form of the timeline, if at that particular time, if the goal corpus size is not adequate enough, then it's definitely a setback, a failure, and there is always a suffering, there is no alternative. Let us understand with an example. Suppose if you are pursuing a retirement funds goal, and at the age of the retirement, if the retirement funds goal corpus size is not adequate enough to cover our retirement year's expenses, there is no alternative. It is genuine suffering. So this is a non-negotiable goal. While for negotiable goals, when we reach the goal deadline in the form of the timeline, and if at that time the goal corpus size is not adequate enough, there is an alternative. Say if we are pursuing a foreign vacations personal financial goal, and at the time that the goal deadline is reached in the form of the timeline, and if the goal corpus size is not adequate enough, there is no issue. We can think of an alternative. We can think of another foreign destination vacation. So in my opinion, the top three goals, that is the emergency funds, retirement funds, and kids education funds, are non-negotiable goals, and the rest too, that is the assets and experiences and the kids marriage, are negotiable goals. The logic or reasoning behind differentiating the personal finance goals into these two classes is to have a different approach in pursuit to that realization of the particular financial goals. For non-negotiable goals, when we pursue them, our approach should be conservative to moderate at the best for the non-negotiable goals. But if we are pursuing a negotiable goals, then we can become aggressive also, because there is an alternative, and if the goal is not realized, there is no genuine suffering. Next, one stands for one SIP for one goal. Basically, it is the essence of the goal-based investing. It is a strategic marriage between the SIP and the goal-based investing. It helps us continue our focus on the goal rather than the capital market fluctuations. Next. Zero stands for 0% volatility assets like bank FD or the liquid funds. Dear colleagues, when we pursue a particular financial goal and when we reach the goal deadline, either in the form of the timeline or in the form of the goal corpus size, it is always advisable that we shift the goal corpus funds from the high volatility assets to zero volatility assets. This can be done in two ways. It can be done gradually also. Say if we are 12 months, 18 months or 24 months away from our goal deadline in the form of the timeline, then this is the time that we should start gradually shifting the funds from high volatility asset to 0% volatility assets like bank FD or the liquid. But say if we have already achieved the goal corpus size much before the goal deadline in the form of the timeline, then it is advisable that we do a lump sum, single swift movement from the high volatility assets to the 0% volatility assets. The logic or reasoning behind this movement is capital markets are highly volatile. There is no guarantee that they will remain steady or they will move upwards only. It is equally possible that they move downwards also. And in that case, the goal corpus that is realized with the high volatility assets may suffer and the goal corpus may come down also. So, dear colleagues, it is always better to start shifting the funds from the high volatility assets to 0% volatility assets as we come close to our goal deadline in the form of timeline or in the form of the goal corpus size, and be safe rather than being sorry to have not adequate enough goal corpus size at the time of the goal realization. Now, a few words about the ongoing controversy about the investments strategy, whether lump sum is good or SIP is good. Dear colleagues, both are good strategies, but they are for the different types of investors and for the different logical reasons. Dear colleagues, basically in the capital markets, it is the exposure time that is more crucial than the timing the capital markets. Lump sum investments may be an attempt to time the capital markets, while SIP has a genuine strategy to increase our exposure time in the capital markets. So SIP is a step forward for the average investors. But for those investors who are disciplined and regular in their investments month on month, for them, lump sum investment is also good enough because it provides them flexibility in their investments. But for the average, non-disciplined and the impulsive investors, SIP is the choice. Dear colleagues, to start any journey, a small first step is must. Similarly, in journey to the wealth creation, journey to the financial independence, SIP is a such small, simple first step. But as you become mature enough with this SIP management, one can go for lump sum investments also. Now I have identified 5 personal financial goals. Now in this action plan, I'll identify which category of the investments or which category of the mutual fund investments is good enough for that particular financial goal. First is the emergency funds. For emergency funds, it is the short duration debt funds or money market funds that is the right choice. For retirement funds, it is the NPS or National Pension System that is the best choice in my understandings. For kids education, aggressive hybrid funds is a good choice. Now, the most important personal financial goal is that of assets and experiences. For this particular goal, I have divided the investment corpus into 2 investment strategies. One is active investment strategy. In active investment strategy, it is the fund manager who will decide which shares and scrips are to be bought. And they do have a comparatively higher expense ratio. and the rest 50% I recommend to invest in the passive or the index funds. Herein, it is the index or it is the algorithm that is mirrored or copied by the fund manager, and so comparatively their expense ratio is on a lower side. So for assets and experiences personal financial goal, 50% of the corpus should be invested in the FlexiCap active funds, and the rest 50% should be invested in the passive index funds. In passive index funds also, I have recommendation for the two types of investment categories. The first 25% should go in index funds. This provides one exposure to the entire capital markets large cap universe. And the next 25% should go into the Nifty multi-cap 50, 25, 25 index funds. Herein, the investor gets an exposure across the large mid-cap and small-cap segments and across the 500 companies in the capital markets. The advantage with this Nifty multi-cap index funds is that there is an ongoing redistribution of the profits that may have occurred either in the large cap or in the mid-cap or in the small-cap segment in such a way that the original ratio of 50 into large cap, 25 into the mid cap, and 25 into the small cap is retained. So there is an ongoing profit booking in the most tax efficient manner. That is the advantage with this 25% exposure into the Nifty multi-cap 50, 25, 25 index funds. Kids marriage, in my opinion, is a totally negotiable goal. So 100% exposure to the equity in the form of index Nifty 250 large and mid-cap funds is a good choice. Dear colleagues, these are my simple understandings. They are not like carvings on the stone. They are definitely subject to choice or change as per your approach. My humble request is that whenever you make a change, see to it that your approach is rational and reasonable. Next. Now I share with you an app which will help you in planning and procedural process in the SIP management. It is freely available on the Google Play Store by the Nilesh Harde. It will help you calculate the future value of your SIP investments. It will also help you calculate or define the size of a particular goal in your personal financial life and how much monthly SIP is required to realize that particular financial goal. Basically, it takes away all the personal financial mathematics related issues along with the wealth generation or SIP management or personal finance in a very easy manner. So do download it and do get benefited. Next. In conclusion, I share with you a few words that are of meaning and significance to me. Dear colleagues, legends do not do the different things, they do the things differently. We are anesthesia doctors, we are above average investors. So our SIP management has to have a different perspective. Our SIP should be there with a strategy, it should be strategic SIP. Warren Buffett has said, what the wise does in the beginning, fools do in the end. Dear colleagues, the way in our anesthesia management, we have preoperative workup, preoperative examination, preoperative planning to manage our anesthesia cases in most efficient manner. Similarly, in personal finance also, in journey of wealth creation also, in SIP management also, we should have strategy in the beginning like a wise investor, and we should not be a fool investor to think about the strategy in the end. Dear colleagues, it is not what one listens or learns in the webinar, but it is what one achieves with its execution in the life that is more crucial to succeed. Whatever knowledge or information is received in the webinar, if it is not acted upon, it is simply information entertainment. But whatever knowledge is received, information is received, and whatever is applicable to you, whatever is appealing to you, if it is acted upon, it is this action that will lead to success. Now I'll rapidly revise what I have said so far. 7 means 7 years of SIP duration. 6 means 6 most important words in the personal finance, goal-based investing and asset allocation strategy. 5 means 5 important personal financial goals in all our lives. 4 means 4 stages of the SIP life. 3 means 3 golden rules of the SIP management. The most important golden rule of the SIP management is step up SIP. 2 means differentiation across the 2 classes, negotiable and non-negotiable, and diversification across the 2 AMCs when the goal corpus size becomes huge enough. 1 means 1 SIP for 1 goal. 0 means bringing down the volatility to 0% when the goal deadline is reached, either in the form of the timeline or in the form of the goal corpus size. That completes the rapid revision. Next. Dear colleagues, thanks a lot to one and all. I repeat my blog address rkhgajjar.wordpress.com. To explore extensively, to read selectively, and to develop the understandings in the personal finance and financial mathematics is my passion. To write about this on my blog and share it with the others is for my own personal pleasure. My dream is that may all anesthesia specialists be financially independent at least before they retire. And all those anesthesia specialists who are already financially independent may remain so throughout their lifetimes. I end my presentations with my sincerest prayers to Lord Swaminarayan that He, the Almighty, may help you all in your journey to the financial independence. Dear colleagues, strategic SIP is simple and successful. In other words, it is as Sapne in progress, another full form for the SIP. It is dreams marching to the reality. Dear colleagues, I end my presentation with a mantra: always dream big, maybe start small, but act now. That completes my presentation. I am obliged. Thank you all once again.
Thank you so much, sir. Very good presentation, short and sweet, to the point. I think screen sharing, can we stop? Dr. Kumresh sir has come. Before we go to Dr. Kumresh, a few points. See, many of us, what we do is, and what I have interacted with our colleagues is, I have started a SIP. How much you have started? What is your goal? In which fund? Somebody will say, there was someone who guided me, so all his funds are in one AMC only. See, these are common mistakes. These are common mistakes. Even Dr. Gajjar in his presentation said, never invest the whole amount into a AMC. Sometimes some problems do occur. You may not come in a shock. Of course, money will be returned to it. Now things are regularized. SEBI is there. So many things are there. But don't commit that mistake. Number one. Number two is always have some goal in mind. Whenever you want to start a SIP, what is the purpose? How much amount is needed? What is your goal? I'll just share a few points here before we go to. It was in 2017 when Dr. Kumresh sir was teaching us. I was also very naive. So daily there was teaching in the group through slides and PPTs and all. And then one day I asked Dr. Kumresh sir, you are an expert. Please tell me in which fund should I invest? And that is the most common question which is asked from the experts. So he gave me a form. Okay, fill this form. And that form, everything was written. What is your earning today? What are your expenses? How many kids you have? How much money you expect in education? How much will be needed for your retirement? And that is how that sense of responsibility and maturity comes when you analyze these facts. So do invest after thinking, and as Dr. Gajjar sir has in a very concise manner explained that simple and straight. He always keeps it very straight and simple in the group. He always in the end he writes as simple as that, sir. So Dr. Kumresh sir doesn't need any invitation. Dr. Bajwa sir, you want to say anything?
And after that, Dr. Kumresh sir.
So Kumresh sir doesn't need any introduction as Dr. Gajjar sir, and we are very pleased today that two of our best experts have come, and the attendance in itself is showing your recognition, sir. 328 is still attending and wanting to hear from you. So most welcome, Dr. Kumresh sir. Now the corpus is created. Let the members know what to do with this.
Good afternoon, National ISA President, Secretary, Treasurer, and esteemed Governing Council members and ISA members. Thank you. Gajjar sir has clearly gave us the roadmap for how to create the retirement corpus. So, and we are on a mission to educate, inspire, empower, and transform 1 lakh doctors on financial independence. And thank you, ISA Financial Advisory Group, for making this webinar to happen. And I thank my mentors who taught me this concept, Dr. Murli, Dr. Krish, Mr. Dharmendra Satapathy, and Puttaswamy Gowda. And first, I will put my disclaimer. Those who have got risk appetite and risk-taking capacity only should invest in equity markets, because it is a little bit risky. We should understand what's the risk, and then only we should invest in equity markets. That's what the equity market is. We are claiming ourselves financially independent when we have created adequate corpus. I know many of these in this group have got adequate corpus, but they don't retire because they don't know how much it is needed for their retirement corpus. So for that, there is a very good strategy that is known as retirement bucket strategy. This is in Excel sheet. So I will shift myself to Excel sheet. Is Excel sheet visible, sir? Virendra, sir?
It's visible.
Yeah. So I am 50-year-old. I want to retire today. So my life expectancy is 100 years. So I need to have a corpus for 50 years. My current monthly expense is 1 lakh rupee. And generally, we have to assumptions to be made. The inflation is 6% and liquid percentage, which gives equal to that of inflation. And debt funds generally gives 1 to 2% more than liquid funds. So 8%. If you add little bit of equity, asset allocation, like equity, debt, and little bit of gold, the return increases. So we expect a 10% return, and equity, we expect only 12% return. So this calculator will show if you have got 2.41 crores today, I can retire. So the main problem in retirement is mainly the medical, as we already seen in our webinars, our wealth is destroyed only in our health-related activities in retirement. So what we suggest is to have 50 lakh to 1 crore of Mediclaim policy. That is a must for retirement. And we should keep that 2.41 crores today in 5 buckets. Bucket 0 is, that is emergency fund. In spite of keeping Mediclaim policy, this only is going to destroy our wealth. So 24 lakhs is we are going to keep in liquid funds. That is only, we are going to have it only in case of emergency, because in many hospitals, we don't, we have to pay something for the disposables. So for that, we can take that money out, and 24 lakhs is a very good amount for in today's class. If inflation increases, the liquid fund return also increases to, it will keep pace of the inflation also. So now I'm going to retire in January 1, 2025. This is the first month of my retirement. Because as a freelancer, many has got the worry how to create our own pension plan. This is the one of the methods to create our own pension plan. If you have got 2.41 crores today, and if you keep liquid funds, debt fund, asset allocation fund, equity funds in this manner, then we can retire today. So this month I am going to retire. January 1, 2025 is my first month of retirement. So till 2028 December, the first 36 months of our monthly expense of 1 lakh rupee, I should keep in liquid funds, 36 lakh today. So January 1, 2029 is my 37th month of my retirement. So from there, 28, 29, 30. 37th to 72nd month of the pension money that I need to get, I should keep in bucket 2 that I invest in debt funds today, 33.12 lakhs. So for the next 6 years, I don't want to have anything in equities. As Gajja sir clearly told, if you are going to invest in equities, minimum 7 to 8 years, you should be there. That's why as a retiree, I don't want to take risk in equities for the next 6 years. Then 73rd month of my retirement, that is January 1, 2031 to 34. That 73rd to 120th month, first, then 7th, 8th, 9th, 10th, 4-year retirement money, I am going to keep in asset allocation fund. That is equity, hybrid, as well as in gold. That will give fetches 10%, we assume. Today, we are going to invest 35 lakh rupees in asset allocation funds. Rest of the money that is going to be required from 61st year to my 100th year, that is next 40 years money, I am going to invest in equities in bucket 4 1.12 crores. So if we invest like this, first 3 years of money, I'm going to invest of my retirement period, I'm going to invest in liquid funds. 4th to 6th year of my retirement, I'm going to invest in debt funds. And 35 lakhs, I'm going to invest in asset allocation fund. The money that is required after 10 years, I'm going to invest in 1.12 crores today in equity funds. So is it sufficient for my lifetime? Let us do the workings. First month of retirement, January 1, 2025, we are going to withdraw money from 36 lakhs. So this is the workings. Today, I am going to retire. 36 is the corpus that is there in liquid funds. I am going to withdraw 1 lakh rupees for my pension as a pension. So 36 lakhs minus 1 lakh is corpus after withdrawal is 35 lakhs. And this 35 lakhs is going to grow 6% per annum, means at the end of the month, 35 lakhs 17,000 is there. The end month corpus is next month beginning. Corpus at the beginning of this second month, 1st is February 2025. Here, we don't want to, I don't want my lifestyle to be decreased. That's everybody's worry. So we are going to add in 6% inflation. See, in 13th month, we are not going to withdraw 1,06,000 as 6% inflation. The next month itself, we are going to put inflation. So I am going to withdraw 500 rupees extra from next month onwards. So this money minus this is corpus after withdrawals, that is 4 lakhs. And this grows at 6%. So month end, this will be there. Then this will be the next third month, 1st January 2025, corpus at the beginning. Again, I'm going to add inflation. So I'm going to withdraw extra 500 rupees. Corpus after withdrawal. Like that, if I start withdrawing from that first bucket of corpus of liquid funds of 36 lakhs, this will last for 6 months, 36 months. After that, this bucket will become 0. Because what is this bucket is, this bucket is need to supply me 1 lakh inflation beaten lifestyle for next 36 months. It has done this job. So this job is over. What to do after 36 months means we have to withdraw from the second bucket. Already we are invested today 33.12 lakhs in debt funds. So this 8% it will grow. In 37th month, it might have grown to 41.72 lakhs. See, we are putting 6% inflation for 3 years means it's not 1.18 lakh. It is 1.19 lakh because inflation is also compounding. So 37th month minus 1 lakh inflation beaten. This minus this is this amount. Month end this, and it will be growing at 8%. So like that, if you start withdrawing, this bucket will last for 72 months. After that, this bucket will become 0. So next 6 years of inflation beaten 1 lakh is done through these 2 buckets. What to do for the third bucket? After 6 years, we are from the 7th year, we are going to withdraw from the third bucket. 35 lakhs that is invested today. It grows at 10% for the next 10 years means at the end of 72 months or at the beginning of 73rd month, we are going to have 63 lakhs. Like that, inflation beaten, if you are going to withdraw for next 4 years means till 120th month, it will come. After that, this bucket will become 0. So for first 10 months, we are retired with 1 lakh inflation beaten bucket from the third bucket, 1, 2, 3 bucket. 10 years, we have not touched the equity bucket. This 1.12 crores is growing at 12% for next 10 years means at the end of 121 month, it will be 3.41 crores, 47 crores. If you are starting withdrawing money from this bucket, it should last for, because 50 years means we should last for 12 into 50 is 600 months. 12 into 5 are 60. 600 months, the money should come. We have to see whether it is coming for 600 months. Yes, it's coming. So, see, the money is still coming from that, and 500 months, 800, okay, 600, it's coming, nearing. 600th month, the bucket is 0. So till my 100th year, today I'm 50-year-old, till my 100th year, money is there. What today the cost of 1 lakh because of 6% inflation, it is 18.33 lakhs. We are going to withdraw 18 lakh per month. So last year itself, at my 100th year, I am going to withdraw 2.4 crores. That's the money that we have invested today. So this money is sufficient for me to make 1 lakh inflation beaten lifestyle for my next 50 years. So this is the bucket strategy. That is, first we can see that we have seen the first bucket strategy. Then we should know the power of 1 crore. If we have got invested 1 crore in equity mutual funds, and we are going to withdraw 50,000 per month, if you give 12% returns in equity mutual funds, and we are going to withdraw 50,000, and inflation is 6%, means we are going to see how many years it is going to come. So investment amount is 1 crore. Expected return from equity mutual funds is 12%. Inflation is 6%. And we are going to start investing from first month onwards. See, investment amount is 1 crore. If you are going to get 12%, means every month we are going to withdraw 1%. 12% means 12 months, 1% from 1 month we can withdraw. But what we are going to do is we are going to withdraw only 50,000 rupees. So 50,000 into 12 is 6 lakhs rupees. We are going to withdraw 1.12 crore minus 6 lakhs is at the end of first year, I will be having 1 crore and 6 lakhs. I have withdrawn 6 lakhs in the first year. The first year end corpus is the second year corpus beginning. And if it grows 12%, is 1.18 crores. The second year, I am going to add inflation of 6%. So 50,000 rupees this year, I am going to withdraw. From next January 1, 2026, I am going to withdraw 53,000 rupees. 53,000 rupees into 12 is 6.36 lakhs per annum. So this minus this is year-end value is 1.12 CR. So totally I have withdrawn 6 lakhs plus 6.36 means till second year I have withdrawn 12.36 lakhs. In second year's closing balance is the third year opening balance. And the returns, if you add, it will come on to 12%, means 1.2 CR. The third year, we are compounding. Instead of 56, we are going to withdraw extra 180 because 6% compounding happens also for inflation. So like that, if I withdraw for next 50 years, today I am 50, so 53, at the age of 100, my 100th year, I will be withdrawing 8.68 lakh per month or 1 crore per annum. Today we have invested 1 crore and we are going to leave the next generation 18 crores. Total amount I have withdrawn is 17.42 crores. This is the power of 1 crore. If you have got 1 crore invested in equities, if you get 12% return, and if you are withdrawing only 50,000 with 6% inflation, what we are going to have at the end of 100 years is 18 crores. We are going to give to the next generation. So if you have got 1 crore, if you get 12% with 6% inflation, we can live rich and die rich. Many of us in this group, have got more than few crores, and still they don't know that they are financial independents, because many of them might not be invested in liquid assets. Vijay Khurana sir has clearly told that he has invested only in financial assets. So liquidity is there means we can easily withdraw. We can withdraw partially. So we can leverage and die rich. If the same thing my son, he does for next 50 years, means he at his 100th year, he may be withdrawing 1.6 crores per month, 19.2 crores per annum, and he is going to leave 339 crores to my grandson. This is the power of 1 crore. And I have seen many third generation doctors. In first generation doctor, I asked the third generation doctor, your grandfather or granddaughter, mother might have earned 1 crore 50 years back. 50 years back, they might have earned 1 crore and they have not withdrawn anything. That is, they have invested 1 crore, like 50,000 inflation beaten. If they have not withdrawn, kept it in equity mutual funds that gives return 12% returns, then 50 years, no? In 50 years, we have not done nothing means they might have earned 289 crores. 289 crores. See, 12% returns, 1 lakh invested for 50 years. How much is the corpus? 289 crores. This is the power of compounding. This is the power of 1 crore. So we don't realize the power of 1 crore and we think that we don't have sufficient amount. So what we do, we live poor and die rich. We are going to die rich. So invest in equity mutual funds so that liquidity will be there. All these, if you have got 2 crores in equity mutual funds, then you can withdraw 1 lakh per month, inflation beaten perpetually. Perpetually. So this is the power of 1 crore. You can live rich and die rich. Next, we will go to our PowerPoint. This is the power of 1 crore. The third strategy. Generally, what we do, we generally buy real estate for our kids so that they should not suffer in our eyes. So they can live with the rental income of that house. That's why we buy real estate. How can we make financial independence and retire early for the kids? I know that at the age of 50 years, I am financially independent. How to make my kid also financially independent, retire early at the age of 50? So that is the concept. I planned for my daughter when she was 10-year-old and decided fire age is 50. She is seeing 1 lakh lifestyle today. So inflation, we are going to keep it as 6. Expected return is 12% in equities. That means current cost of 1 lakh, current cost of 1 lakh will be in next 40 years will be 10 lakhs per month because of inflation. To give 10 lakh per month means we have to create a corpus of 20 crores. As we have seen the power of 1 crore now, if there is 1 crore means we can withdraw 50,000. 2 crores means 1 lakh. To withdraw 10 lakh per month, we should have a corpus of 20 crores. How to create a corpus of 20 crores after 40 years? Very simple. Just invest 17,312 rupees per month for next 40 years to create a corpus of 20 crores for financial independence, retire early for our kids. How can I invest 17,000 for 40 years? You invest 20 years, then the kid from 31st to 50 year, let him or her invest 17,000 rupees per month from 31st to 40th year. sorry, 21st to 40th year. First 20 years you are going to invest. The next 20 years, kids are going to invest. See, we are going to invest 17,312, expected rate 12%. Investment duration 20 years means how much I am going to invest in my lifetime? 41.55 lakhs. The same amount, that 41.55 lakhs, my kids are going to invest for next 20 years means total investment means 83 lakhs. In first 20 years, what's the corpus future value? 1.71 crores. But at the end of 40 years, what's the corpus? 20.37 crores. What is happening? Power of compounding. The rich will buy time for their kids. First 20 years, the compounding is very small. So I have bought 20 years for my kid, so that next 20 years, the compounding will bring the retirement, financial independent and retire corpus for my kids. So 17,000 per month with 12% return in equities for 40 years can make my kid retire rich. One doctor asked, tell me a single lump sum investment I need to do today so that at the age of 50 years, my kid should have 20 crores. Wow. It's very interesting thing. So in future, I need 20.57 crores, 12%, 40 years means today I need to invest only 22.1 lakh. If I invest 22.1 lakh, if it gives 12% return for 40 years, my fire for my kid is done, which is less than first year MBBS fees and private medical college. 25 lakhs today in Tamil Nadu, the private medical college fees is. With less than that, we can make the kid to retire at the age of 50. Let him do whatever he wants. At the age of 50, he can retire peacefully with 10 lakh inflation-beaten lifestyle perpetually to the next generation. So next, we are going to go for another concept. A doctor came to us with they have started investing with us 40,000 rupees per month. Husband 40,000 rupees, wife 40,000 rupees from 2017. For the past 7 years, they were investing with us. So they want to buy a flat for 1 crore. But due to market condition, because of 5%, 15% return, they have got 1.43 crores. So they want to buy that 1 crore flat now. They came for asking to redeem the money and buy that home. Then we suggested a simple strategy, keeping in mind debt-free is middle-class mindset and net debt-free is rich mindset. What is that is, we should use other people's money for home loan. This is the fourth strategy that we proposed them. So they want to buy a 1 crore. Already they have got a corpus of 1.45 crores. We asked them to go for home loan. So what's the EMI? 8.8% means 88,690. What we think is, we ask them to go for 20-year loan, 10-year longer. Generally, we think that the principal amount is 1 crore. If we go for home loan for 88% for next 20 years, the interest amount is by itself is 1.12 crores. It is more than the principal amount. We think like that. So total amount payable is 2.12 crores. We taught them debt-free is middle-class mindset. Please don't get into it. Don't get into it. Net debt-free is rich mindset. You have got 1.45 crores minus 1 crore loan. You are net debt-free of 45 lakhs. So don't worry about these loans. You are net debt-free. Then we have shown this calculation. See, 1 crore loan amount, 8.58% is the interest rate, tenure is 240. That means the EMI is 88,690. So total interest paid is 1.12 crores. This is the amortization table calculator. That means 1 crore we are going to take means EMI is 88,690. Initially, the interest component will be high and the principal will be very low. So balance amount month will be the next month initial corpus loan amount. Like that, if they do for 240 months, then the loan will become 0 at the end of 240 months. So what is for 1 crore loan, we are going to pay 1.12 as interest. So what we have done, asked is, we asked them to pay the minimal down payment of 10 lakh rupees, then stamp paper charges extra. We asked them to keep the money in mutual funds. If it gives 12% return, we will do that EMI, that EMI, we will do systematic withdrawal plan and pay that. The corpus is there, 1 crore is there in equities. From that, we are going to withdraw systematically withdrawal plan and pay this EMI. So we are not working for the EMI to be paid. It is the returns that we get, we will pay, we will do SWP and pay the EMI. So 1 crore is there means we are going to withdraw 88,000. Balance after SWP is this. So it will grow by 12% means month end 1 crore ho jayega. This will be the next month beginning. We are going to do SWP of the same amount, balance of the withdrawal. So like that, for next 240 months, if you withdraw, then total amount of withdrawal of SWP to pay the EMI is 2.12 crores. That is 1 crore of loan amount plus 1.12 crores of interest amount. So total SWP done is 2.12 crores. Even after that, we are going to have 2 crores. That is, if you get 12% returns, after withdrawing is doing SWP for 240 months, we are having the flat, we are having 2 crores also. If it grows at 12% in equity mutual funds, but if it grows at 15%, then after EMI, we are going to have 6.27 crores. This is the power of using other people's money. What bank is doing? They are getting from CASA account, current account, savings account, and fixed deposit amount. They are giving us a small amount, and they are giving home loan 8.8, etc. They are making money profit out of that. The same thing, if we do 12% from equities and 8.8% in interest, home loan interest, this difference of 3.2% is going to create 2 crores. It is money made out of thin air. So we should not think about we have bought loan. Debt-free is middle-class mindset and net debt-free is rich mindset. So we told this concept, they accepted and they are withdrawing and they are going with the flow. The rest of the money, first 36 months now, what's the liability coverage? We asked them to go for a liability coverage for that home loan also. If something happens, then the liability coverage we have asked them. As a downside protection strategy, what we have told is, we are keeping aside some 24 lakh rupees in liquid funds. In case of any market fall, we will pay the EMI from that. If we are going to shift that into equity also means we have suggested sovereign gold bonds they have got. That's loan we can go. During market fall, we should not withdraw the money from equity mutual funds. We can go for sovereign gold loan or unused old broken jewelries, loan or sale. We can do that, or loan again mutual fund. These are all the downside protection strategies we have told to that couple. And also we educated them. Correction is temporary and growth is permanent. We all know rule of 72. Every 72 years, if the inflation is 7.2, the money is, the buying capacity is going to be decreased by 50%. So current EMI is 88,000 rupees means after 10 years, because of inflation, power decreases to 44,000. And after 20 years, again, it is half. So 22,000 only we are going to pay as EMI of today's cost. So what are all the advantages? Many banks offer 5 bips discount to the women borrowers. We ask the female doctor to make her as a borrower and husband as a co-borrower. Under section 24, home loan interest, 2 lakhs can be deduction each. So for 4 lakhs, they can claim deduction, 2 lakhs each. And the home loan principal, 1.5 lakhs can be deducted under ATC. And SWP is paying EMI. They are not actively working for that EMI. While withdrawing, what happens? The long-term capital gain, every year we can take 1.25 lakh profit tax-free. So it is by withdrawing that automatically this happens because of SWP. Tax efficiently, we are going to do that EMI payment tax efficient, because when we withdraw money, capital as well as the profit will come. The capital gains automatically it's booked. So 15,000 rupees tax per annum. If there is long-term capital loss, that can be set off with long-term capital gains in subsequent 7 years. Not only that, in case of emergency, we have got liquidity. When rate cut happens, ensure that rate cut reflected in loan amount. We have to go to the loan given company and ask them to reduce the interest rate with paying a processing fee. Another social advantage is there, telling relatives that you are having 1 crore loan. So because many will come and ask us for hand loan. Many hand loans will not come. Tell the relatives that you are having 1 crore home loan. These are all some of the advantages. As Khurana sir and Gaja sir has clearly told, what are the principles that they have followed to create that corpus? Patience, discipline, faith in the future. See, they were living below their mean. They were doing 80,000 rupees per month SIP for the past 7 years. They might have got loan for 88,000 rupees, they pay as EMI. At that time, they didn't buy any home at all. They were really living in a rental. So they were living below their mean. Even though they can buy 1 crore flat at 7 years back, they didn't buy. So they were living below their mean. Instantly, they didn't go and buy that home. So they delayed their gratification for 7 good years. That is reaping their benefit. The patient during Corona, they were patiently waiting because it was minus. The amount that they were invested was more than the actual amount at that time because of the market fall of 40%, 38 to 40%. They were patiently waiting for the market to recover. And they were also disciplined to continue their SIPs. They had faith in the future of equity markets. Also, Khurana sir had clearly told asset allocation, diversification, and rebalancing we have done. So these are all the principles they followed religiously to create a corpus of 1.45 crores. That's how they can reap the benefit now. If you are going to go for a hospital loan, the entire expense can be, interest can be shown as an expense. If you are taking home loan, only according to section 24, only 2 lakh per person we can deduct. But if you are going to build a hospital means the entire interest can be shown as an expense. Also, another advantage is there can claim depreciation for the hospital building also. Then we are going for another strategy. A doctor came with 1.25 CR. Last year they came to us with 1.25 CR that they have to pay 25 lakhs for the next 5 years for their kids' education who is doing private medical college. Next 5 years they are going to pay. Can anything to be done? Then again we told them to go for loan. This time, educational loan. This time, we asked them to go for education loan and asked him to keep the invested money in equity itself. So what is the current corpus? They have got 1.25 crores. MF returns, we assume 12%, 6 years. And education loan interest is 9.5%. So 5 years, we asked them to take educational loan, 25 lakhs for next 5 years. First year, 25 lakhs. The interest amount 9.5% is 2.37 lakhs. If you add these two things, 27.37 is the first year end total loan amount. Add 25 lakhs for the next year. So 52.37. For 52.37, interest is this. If you add these two, this. So every year, for first 5 years, 25 lakhs we are going to get as educational loan. 6th year house agency, there is no loan, one interest part. So totally 1.81 crore is the loan amount. The same amount, if it kept invested in equities, if it gives 12% for next 6 years, the corpus created is 2.46 crores. We can easily close this corpus created with the loan amount. So we can have 65 lakhs in our hand. But we are not going to do that. We are going to convert this 1.81 crores into EMI for next 8 years. So 1.81 crores, 10 years, 8 years means the EMI is 2.70 lakh per month. So this is the amortization calculator. So if it goes for 8 years, the loan becomes zero. What's the interest paid? It is 78 lakhs for this tenure of entire 8 years. It is interesting to know that interest paid on education loan is allowed as deduction under 80E. So you can deduct entire 78 lakhs as educational interest deductible under section 80. How to pay this 2.70 lakh per month as EMI? See, this corpus 2.46 we have created now, that we are going to withdraw from the MF corpus. 2.46 corpus that's created, we are going to do SWP from this corpus, balance, and it grows. So next 8 years, we are going to withdraw 2.7 lakhs per month from the corpus. Even after that, paying SWP of 2.59 crores is left with 2 crores. This is the money that is made out of tenure. After MBBS, after 8 years of PG, all those things, even if he doesn't get adequate practice, from these 2 crores, he can withdraw 1 lakh inflation beaten perpetually. So this is another big advantage of going through this process. Debt-free is middle-class mindset and net debt-free is rich mindset. If instead of 12%, it has gone to 15%, means the end corpus is 4.50 crores. At the end of, after closing the loan, no, 4.50 crores. Our kid can live peacefully with 2.25 lakh inflation beaten perpetually. So why we should not use these concepts of SWP in our lifetime practical situations many face. So generally we invest in real estate because we don't want to pay 30% tax to convert that cash component to white. So let us see what happens, because we are running a poll in our group that many of us have told that it has real estate has given less than 10% equity returns. So we have done that. What we are going to do, 1 crore we are going to invest in real estate that gives 10% return. So that means 50 years we are going to have that real estate, means it has grown to 117 crores. Today's 1 crore, if it grows by 10% means 117 crores after 50 years. The same thing in equity mutual funds, you have paid 30% tax. So 70 lakhs only invested. If it grows 15% means after 50 years, we are going to have 758 crores. See the vast difference. See, the transformation happens at the 8th year. The real estate investment and mutual fund post-tax investment will become one and the same, 2.14 crores. After that, it grows like anything. So don't afraid to pay tax and invest in equity mutual funds. Don't lock your money into real estate and live rich, live poor and die rich. Please pay the tax and invest in equity mutual funds so that you can live rich and die rich. And many feel that the tax is gone for the debt mutual funds. Fixed deposits and debt mutual funds has got 30% tax nowadays. So what's the use of investing in debt mutual funds? Many ask me. See, tax deferment, how can it make wonders? Let us see. 1%, 1 crore, 7%, and tax is 30%. We are in 30% tax bracket, means 1 crore, 7 lakh, I am getting returns. For that, I need to pay 2,100 tax. So after tax returns, it's going to get compounded from 1.4, 1 crore and 4 lakhs. If it goes like that, after 50 years, I'm going to have 10.93 crores in fixed deposits. The same amount, if I invest in debt mutual funds, 1 crore, 7 lakh returns, closing value is 7 lakhs. This is the beginning. At the next year, beginning is 1 lakh and 1 crore and 7 lakhs. Here, 1 crore and 4 lakh 90,000. So this difference, no, if you go after 50 years, we are going to have 29 crores. If I even after paying tax, it is 20.91 crores. Because of this tax deferment of 50 years, instead of investing in fixed deposits, if you keep it in debt mutual funds, we are going to have a huge 10 crores. Tax deferment of 10 crores. Because in India, 95% of the fixed deposits are renewed year on year. My father's fixed deposit is renewed for the past 40 years without withdrawing. So like this, in debt mutual funds, because of the tax deferment, we can create for 1 crore, 50 years, 10 crore tax deferment, we can easily have. So these are all the advantages, and thank you for your patient hearing. Happy to answer your queries. Thank you.
Well explained in very detail, and I know many of the members might be going through your calculations, but having read the questions, one thing I can say, see, many are asking, sir, 12%, 12%, 12%. So those members who are with us from 2017, including me, who started investing into mutual funds after your teachings, because I continuously keep on having a review by system of polls and all. And all of them, because what was told was that average return over a period of 8 to 10 years is 12 to 15%. It is what is being taught since 2017. This is historically that if you invest for minimum of 8 to 10 years, you will get 12 to 15% return. And when I rechecked it, with all those who started, although the number was not very high, because at that time the group strength used to be very low. I think it started with 128 and then went to 256. Now, of course, we have 1000. And one more saying that the best confidence which you get is your own colleague. For example, there is one anesthesiologist in my department. We are in the same earning bracket, almost around. If he is doing something like this, so I get more convinced rather than talking to a financial advisor and all. So for those members who are asking, I'm telling this in this platform that we have at least 30 such anesthesiologists in our group who started mutual funds investment in 2017. And today, all of them have an average return of more than 17 to 20%. That is luck. We told 12 to 15. So don't worry. If your period is more than 8 to 10 years, rest assured you will get this much return. That much I can assure. So lot of questions to Dr. Kobresh only. But before that, some questions for Dr. Gajjar sir initially. I think I'll have to go longer because many people got confused with your calculations. I mean, it's not so easy the way you keep on giving 600 months and 800 months and all. But I can understand. So what the question was asked about? Where is that? So many questions are there. I forgot. That was a good question too. I think someone who asked that, can he again ask that question to Dr. Gajjar sir about SIP? Because so many questions about your talk, sir.
I think there was one question where one has asked whether SIP and SWP can go on together also.
Yeah, that was also a question. Yes, yes.
It can go on, but it depends upon your conditions and your planning. It can definitely go on. But the corpus for the investment in initial stages has to be huge enough so that it permits SWP and it permits growth as well.
Okay. So before we go for questions, Dr. Bajwa sir, you wanted to say your experience also. Now you are a very experienced person since 2002 or 2003. You mentioned you have been investing into markets. So that's a huge experience of more than 20 years. Please share your experience with the members.
I think all the three webinars today, the three topics were excellent. The importance of SWP is very, very important after SIP. So it's a very well explained. But considering the heterogeneity of the population, of life values, of your family structure, so many ups and downs, and the political, geographical, social, familial backgrounds, the expectation of everyone living from 50 to 100 years is not feasible. You may be living for 65 years, 70 years, 75, 80. So planning for 50 years, I think if you are going for systemic withdrawal plan, may you still be living poor. I think you go with that also. You don't know the certainties of life when they're going to end. So I think whenever we are planning for SWP, these are the specific money kept in those quarters where you can plan a minimum. It should be a minimum you should be having per month for a good life. Rest, I think there should be specific funds also. I may not be able to explain in entirety here, but considering that so many geopolitical things coming, the inflation, depreciation, the rupee getting continuously weaker for the last 15 years now, almost going to 86, and so many other factors, your inflation at the even the vegetables in the equity markets, very highly volatile. So planning for systemic withdrawal, sometimes becomes very difficult for a person to really adhere to in such a disciplined manner. Everybody cannot be same disciplined as all the five fingers of our hand. So it's a very difficult scenario, but in reality, this is a fact. You want to live good, you want to live rich without knowing when is the last day. I think from 50 onwards, you should count every day as a bonus day in your life. Keep living a good life, not just looking at the wealth. See the health is the most important. Health and living accordingly, but money part definitely it needs a very good systematic planning. I think that was very well explained, and many people have asked the questions. I think I should have kept one moderator, also screen moderator, who could have gathered all the questions so that we could have
I
answered
was
only
going through, but last presentation, actually.
I think everybody can unmute themselves and ask a question directly to the
So
speakers.
one question I got through just
Raising hands.
now.
Everybody raise hands if you want
No,
to
one
ask.
question I just went to, very interesting one, Dr. Kumresh, for you was that can he simultaneously, take a loan and repay from SWP without much complexities? I mean, what you
Already we are
said,
doing that. If you have got 1.25 crore corpus or 1 crore, they can easily go for home loan and do that because the interest 8.8% is we are in the peak of the interest rate cycle. From here onwards, interest rate is going to go down 90% of the time. As per our, because in world now, US, there is interest rate cut. In UK, there is interest rate cut. And India is going to go after probably the elections. Maybe, I don't know. I don't predict, I prepare. So we are at the peak of the interest rate cycle. From here on, it's going to go down. So interest rate is going to go down. And if you adhere to equities with thick and thin, then it will give returns. Patience, discipline, faith in the market. Many people ask many questions, but what I suggest is, please have this as a guideline. Because you may be having crores of rupees, but still running for cases and working 10 to 5 or 10 to 6. You can decrease your workload, take care of your health, family, friends, relationship, and purpose of life. Still, we are work. We have become, as a doctor, we become workaholic. We don't take care of health. As IMA Pune study says, average lifespan of Indian doctors is 10 years less than that of the Indian average population. The doctors are not living long. And IMA Kerala study also tells the same thing. So we should take care of our health as Professor Bajwa sir has told us. We are not taking care of our health. We are not taking care of mental health. So we die earlier, 10 years less than the health of the average Indian population. So have this as guideline. Work on your terms. Financial independence means we are not asking you to watch the TV, reading newspaper, and staying in easy chair. No. You should work on your terms. You should be able to refuse a case if you feel stressed. That is our main agenda. So we ask not to stop the work. You should work on your terms. That is financial independence. What's the power of money? You should spend your time in whatever you want, in the way you want, how long you want, with whom you want. That's the power of money. We are having so many crores of rupees. Still, we work for 10 to 5, or as a freelancer, I have to go day and night. That I don't want. So hereafter I want to work on my terms. So please do a small practice. Instead of earning in lakhs, do a small practice, peaceful practice, work on your terms. That is the major agenda of power of 1 crore and retirement package strategy. If you have got 2 crores, and if you do a small work, peaceful cases, we can live peacefully. No need to run here and there, and we should need not pump our adrenaline in taking risky cases. That's the main motto. not inflation, 12% returns. You have got corpus means that will give a lot of confidence on you.
Very well
You can
said,
help
sir.
us.
I think very well said.
Another
Dr.
expert,
Virender,
no, one
Dr.
second, one
Virender,
expert of his contemporary. So
before
going to be a tough
forward,
question for him. Dr.
no,
Chintan
just going
Vyas, who is
before
equally,
forward, Dr. Virender,
Ah.
is important part.
Acha.
I think got a very, very important point from the deliberation done by Dr. Kumaresh, sir. Why not we make a basic financial guidelines from ISA for every member? I think we should go forward with it. So many experts are there. I think Dr. Virender, we will all together work for basic financial guidelines for every ISA member. That's my point. I was interrupting for that.
All these will be actually why I was more surprised was because see when Dr. Chintan Vyas raised his hand. Now
He will come afterward. You talk.
so,
Just tell me.
we'll discuss this. So he is going to ask tough questions to the speakers. But anyway, what you said, basic financial guidelines. So this part will come to the ISA financial advisor, not to the stocks, because what we advise to the members repeatedly, that can be written in a written format, simple basic rules. And especially for youngsters, I mean, those who are starting their career at 30, 35, because if they start investing at 30, 35, even 15, 20,000 rupees, it is the duration which has been very well explained by Dr. Kumresh sir. So maybe because all these members may not come in our financial advisor group, the strength is limited to 1,000. So if ISA can come up with basic financial advice, it will be very good for the members. And we welcome that initiative, Dr. Bajwa Sahab, and whatever way you guide us, our experts will try to formulate those guidelines.
Sure. Dr. Chintan, unmute yourself.
Thank you, sir. My question for one question for Gajar sir and one for Kumaresh sir. For Gajar sir, I want to ask why he has chosen retirement plan strategy goal to be met with national pension scheme, not our routine aggressive hybrid or flexi cap. I want to know the basic rationale from me. And for Kumaresh sir, I want to ask that like persons like me, I have also invested many in mutual funds since 2008-7. But the things are that it was in so much of funds, and then we have segregated them to 8-9 funds. Still, if I want to switch to SWP for my goal, like kids education or something like that, home loan he has demonstrated. How I should consolidate it, because right now it is in so much many of funds, 20 lakhs in something, 30 lakhs in something, and if I want say 1.25 crores at as he has mentioned for kids education. How I should consolidate? Is there any formula for that I want to know? Because that may be many members think that they have already invested, but not as a strategy to meet with some goal. So how, if already because this question arises because now there is a long-term capital gain tax also. If we are withdrawing from some mutual fund, you are incurring sizable expense as a tax. So how whether you should redeem your old mutual funds and start afresh, or there is some in between strategy that I wanted to know. Thank you.
Can I start?
Yeah, Gajar sir first.
Yeah, I knew very much when I said that for retirement funds, NPS is the best choice. I knew the questions will be there because there is lots of misinformation about the NPS. But the reasons why I select the NPS as the choice is it has compulsory lock-in period, and it is the compulsory lock-in period which helps in creating the retirement funds. And second thing is the lowest expense ratio. In the entire world, there is no other investment vehicle which has got expense ratio as low as 0.93%. That is, if you invest 10 lakh rupees, you pay only 930 rupees for the expense ratio. For all those colleagues who want to really appreciate whether NPS is a good choice or not, do visit my blog. I have written an article about NPS, and I have spent lot of efforts to write this blog. It will take at least minimum 1 or 2 hours for you to read, and in that case I have explained all the details why in my opinion NPS is the best choice. Another misinformation about the NPS is that there is a compulsory purchase of the annuity of the 40% corpus at the retirement age. But we can definitely have a solution to this. We can defer this annuity corpus purchase to the age of 70 years. And when you buy an annuity at the age of 70 years, then the annuity payout will be higher one. And basically in retirement planning, as I have understood, we need to have some component of your total retirement income, which is fixed, which is irrespective of the market fluctuations. So say if you need 100 rupees in a retirement years, there has to be 50 or 40 or 50 rupees, which must be deriving from fixed income like annuity products, because annuity is the only thing which guarantees you to pay out a certain amount throughout your lifetime. So I know, I understand there are misunderstandings about the NPS, but for those who really want to appreciate whether it is a really good choice or not, I request them to visit my blog and read the article on the NPS. But I still believe, as far as the retirement fund is concerned, NPS is definitely a good choice.
Fair enough, sir. Thank you. Thank you. Thank you.
Chintan sir, how to go about it?
Sir,
If you have
Kumar
got,
sir has to answer.
yeah, there are 7 or 8 funds you have got. That means you have got 10%, 15%, 20%. Like that means you can start withdrawing the same percentage. The SWP in the same percentage, because you are doing from 2007 means till January 31, 2018, there is no capital gain tax. So the invest amount will be small and the gains will be more, and the entire amount is tax free.
Yeah,
so if you go withdraw first in, first out basis, then there will be very minimal tax for you. Also,
okay, sir.
that's why we started that Dr. Couple who I invested for equity mutual funds, it started investing in 2017. Even that is long-term capital gains. So automatically the gains up to 1.25 lakhs, there is no tax. After that, for the gains, it's only 12.5. Anyway, I'm ready to pay tax, because if I got gains only, I'm going to pay tax. So we should not much orient towards tax aspect. If I'm getting gains, I often repeat in the group, I'm happy to pay 1 crore as capital gain tax rather than 1 crore as my professional income tax. Because if I earn 3 crores, I have to pay 1 crore 30% tax. But if I earn 10 crores in capital gains, I need to pay only 1 crore. So I want to pay more capital gain tax because it's from passive income. If I get more, I'm going to pay more. So that is my strategy. I'm quite happy with that. I don't want to pay 1 crore from my hard-earned money. So from 7, 8 funds, first in fund, first out means the gains will be tax-free for you till 2008, January 31st invested amount.
Fair enough, sir. Thank you. Thank you.
I
Thank
take
you,
one or two more questions, because now we are approaching around 4:30. So because those who are in the group, they can continuously ask. So those who are not there in the group, anyone wants to ask from the
one thing, sir. I was invited for a National Pediatric Conference pre-conference workshop at Hyderabad. There was pre-conference 1-day financial workshop was there. There in for pediatricians, they are going to have a course. And that course is also coordinated by Dr. Thirumalai Kolundu from Tamil Nadu. He is also a close friend of mine. And many of the senior faculties, Dr. Ajay, Dr. Harish Gopal are there in this meeting. So they are going to form a course for doctors. Why to reinvent the wheel? Let us collaborate with pediatricians and let us have a course, financial course for doctors. Because we ourselves no need to do all the works. If we collaborate, then the work can be easily done. And Dr. Ajay sir from Telangana will also accept that I think Dr. Harish Gopal sir is there in this meet. I specially invite, I give an invitation. They are there. I think we can collaborate with, Harish Gopal sir has said, okay, we are open and we can collaborate with pediatricians and we can have a course, sir. Thank you. Thank you, Harish Gopal sir.
Dr.
Komresh
Bajwa
sir,
sir to respond.
Komresh sir, what to do
Yeah.
here is, you're absolutely right. I think the way we are now collaborating with the other subspecialties and super specialties in anesthesia. For financial thing, rather, it's just not the anesthesia. Many of the surgeons are freelancers, orthopedicians are freelancers. The many surgical fraternities are freelancer. Even the physicians are also freelancers. So why not have a combined, umbrella under which we can go with the financial this one guidelines for all this as an advisor part or as a equity mutual fund, everything to be covered under that, the basics for every doctor, because that will give a very unified projection to the government also that the doctors are unified, not just in the IMA, but in the financial part also, the doctors are now unified under one umbrella. I think we can proceed from here. We can have 4 or 5 representatives from our ISA also, and rest you can suggest from other things. We can collaborate with other specialties also in forming these basic financial guidelines for the all doctors.
Right.
Indian
Can I just
Academy of
put in a word?
Pediatrics, Dr. Ajay sir has told, he has also told IAP. Yes, I will talk with Vijay sir, Ajay sir, Harish Gopal sir, and Dr. Tirmalai Kolundu of pediatrician. Definitely,
Sir, prepare a good draft. Sir, prepare a good draft and proposal. We will go forward with it, sir. I assure
Yes, sir.
you,
Thank you
within
very much, sir.
2 weeks, we will go forward with it, sir.
Thank you so
Right.
much, sir. Thank you, sir.
Pankaj Bhai,
Yes.
he has been into the group since the beginning, one of the founder admins, and it all started randomly. Now it is much structured and so many have joined knowledgeable people. So your thoughts, Pankaj Bhai?
Yeah, first of all, Dr. Bajwa, thank you for your very good suggestion. But about 6 months back, I had got one of the international journals of anesthesia approached me to write an article on financial wellness. They are coming out with a financial bulletin. So, financial wellness of anesthesiologist, Dr. Kumaresh, myself, and Dr. Prashant. 3 of us have written a very compiled article, and I feel in the next 1 or 2 months it should be published finally. I feel it was Update in Anesthesia or one of the journals. I'm not forgetting the name of the journal. But it was, our group has become so popular. I mean, I got a phone call from, आगे से phone आया कि, please write an article on it. So we have covered a lot of details on it, how to go about financially. I mean, that can very well be incorporated in the basic things have been discussed in that article. So once that article is published, obviously I'll be sharing it on all the groups. And secondly, I was happy to see Dr. Vijay Khurana because he was among the first few people whom we had approached when we started these financial groups. And his words of wisdom always were there. Of course, I was happy that he's now back into the group. Initially, he was very active. In the last few years, sir has somehow kept out of the group. I'm sure Vijay Khurana, you'll have an explanation for that.
No. I am in the group. I religiously follow. In fact, this is the only group which I religiously follow. But I rarely participate. There's so many teachers that I hardly have anything to contribute. And
Sir, the experience that we developed over the years is really great, sir. Like I'm just 25 years in the market, and even I suddenly remembered in our stock group we had a what do you call questionnaire about experience. When there was a huge fall last week, so I had a questionnaire for all the members. See, what is everyone doing? And believe me, I realized the advantage of our groups. I should read out that statistics that came out. Stocks, yeah, so when there was a huge fall, I had asked various questions to all the members. The first question was, did you sell everything after the fall? 2 members said yes, they sold everything and got out of the stock market. There were 10 members who responded that we sold stocks in profit. There are 4 members who said we have booked losses in some scripts. 79 members said we had masterly inactivity. This is what we have been discussing on the group many a times. When there is a huge fall, it's the best time to buy. And only those, even Dr. Khurana mentioned that in his talk, that when there is a fall, you can definitely buy, be bold, and actively invest at that time. There was one person who sold all the stocks and bet goodbye to the stock market. Only one. There were 20 who bought and added stocks worth about 1 lakh. There are about 8 people who bought and added stocks more than 1 lakh. And the next day again, there was the market had come up a little, and about 18 members did lot of buying on the morning of the next day of the fall. So the discussion that the teachings that go on in the group, I mean, I felt very, very happy to analyze this survey that we had done. So I feel it's great investing that all of us are doing, and I'm sure Dr. Kumaresh, Dr. Gajjar, and Dr. Khurana will continue teaching. Dr. Virendra Sharma with his flamboyant style of managing the groups is really a great, great asset to have. And I am sure all of us will keep continue growing financially. And there are many NSCs who have already claimed at age of 50, 55, they already become financially independent. So it is good. I mean, this thing that we started about 9 years back now is officially being taken care of. And it's real hats off to all of the teachers on the group. And I really take this opportunity to thank everyone for all their valuable inputs and allowing all of us to grow. Thank you. Thank you, Dr. Virendra and Dr. Bajwa.
Can I say something?
Yeah, sure.
Hello.
Yeah, please. Yeah, please.
This is just elaborating on Dr. Pankaj. I made big investment yesterday when the markets are down. That's one. And this is a small point or advice probably from both Dr. Kumresh and Dr. Gajjar. So whosoever may answer it, just for a little advice for myself. As I told, my PPF account is completing 35 years in March. So I was planning to close the account. I mean, should I close it or extend it for another 5 years?
That better to close, sir, because if the nominee is there, sometimes we may not update that nominee, and getting that money from without a nominee is very difficult. If it is more than 2-3 lakh rupees in PPF account, then we have to get the signature of the first class judicial magistrate.
It is approximately
so that
90.
headache is there. So
it is approximately 90.
I am completing, sir.
31st March. The amount is nearly 90. 90.
Yes, sir. Because already you have got enough corpus. So PPF, no, if it is more than 5 lakh rupees, if the nominee is not there, then we have to get the signature of class 1 judicial magistrate.
Me, of course, nominee is there. My daughter is the nominee.
Yeah. Yeah. If your daughters are there in NRIs, so they have to come and claim that paperwork. Yeah. Now if they're in Bangalore means there's no problem at all, sir.
Can I, sir, add to your Khurana, sir?
Yes.
Because, see, my thought process may differ from the experts. But my PPF account, because my father opened in 97 when I was just studying. So it was in 97, you can imagine it is also around approaching 25, 27 years. In 27, it will be 30. And my corpus is also now growing. So I personally feel, if you don't need the money, because see, you have a huge corpus in equity.
Yes, I don't need it.
Maybe in 10 crores or something. You have a good corpus in mutual funds. I think to safeguard it, apart from the nominee, you can also write a will. And after the will, a registered will, I think there won't be any problems at all. Because let this it will grow like anything now. For last 5-7 years, you must be observing the way it increases without any tax liability.
The compounding is taking its effect, that's right.
Sir, this is the only instrument in which there is no tax liability at all. No tax liability at any stage. So I may be not equal to our experts, Kumresh Saran, but personally I believe that let this also continue, because equity you have 10 crores and all. So let this grow.
Double than that.
It's a safe thing.
What I'm going to differ from Dr. Virendra Sharma a little. Vijay Khurana, sir, spend the money that you have earned all these years, sir.
No, I'm spending money like how much can I spend?
As much as you can. Have a party, sir. We will all come over to Lucknow, sir. हम लोग लखनऊ में आते हैं.
I'm in Delhi.
Okay,
sir, I think apart from the question of Dr. Vijay Khurana, everybody who must be having a PPF or FDs where nominees are registered, I think better not to touch if the money is not needed. They should be spending it, withdrawing it according to the needs of their families. I think that is more important. with the current uncertainties in life, I think we should go according to the needs also, just rather seeing the corpus and the compounding of the interest. I think the needs should
My
dictate
my,
the.
my basic intent to withdraw was mainly I have three assets: stocks, PPF, and mutual funds. I'm gifting stocks to my daughter, and I was just trying to consolidate it only one thing, like mutual funds as a solid one-stop investment. That was the reason. Another 5 years now, I'm already touching 69, 70. Another 5 years would be means 74, 75 years of age. So that was the reason I was planning whether to close the account or not.
Any other
Fair
Dr.
question?
Gajjar.
You can close, Bajwaji.
Any question left? I think anybody wants to give suggestion or any question left from anybody before we close. Another 2-3 minutes, we will close it.
Can I add to the question?
Yeah, Rajnikant sir, boli.
I fully endorse with Dr. Virendra Sharma views. I am not aware what were the issues when the account is to be closed. But as I understand, the compounding benefits when the corpus is big enough is never matched by any other investment like PPF. So if the fund are not required, and if your daughters are, definitely they must be, when they are NRI, they must be smart enough to handle the issues with the bank. So in my opinion, when the funds are adequate enough, good enough, and the kid is strong enough and smart enough to manage the issues, continuing with the PPF is definitely a good choice. I agree with Dr. Virendra Sharma.
All right, thank you, sir.
Sir, can I say one word? Dr. Ajay Kumar from Hyderabad, pediatrician, sir.
Yeah, please, sir, please.
Sir, a wonderful session you have conducted, sir. Both are very excellent speakers and very experienced, wise wisdom they have given. My question as Dr. Gajjar, sir, not a question, observation is actionable. We listen to all the webinars, but when it comes to really practically implementing it, we get a stalling there because probably the logistics we don't know. We are afraid of managing the liquid funds, transferring them, withdrawing them, and again investing them. This is what we need to have practical demos of the procedures. They look simple, but I think that's where the confidence level of the doctors should go up. The theoretical level principles, strategies are very good, and they are fine, sir. My suggestion, sir. That's all.
Agree, sir. Completely agree. It's not easy the way it is explained, liquid fund, debt fund, and all. But what Dr. Kumresh sir was trying to tell, if you can religiously follow, I mean, see, we'll keep on motivating our members that if you can religiously follow these suggestions, your strategy will be more near to the goal. That is what his intention was. But I agree with you. 90% of the members, it's not easy for them to go to liquid fund, SWP, switch over, this and that. I agree. There is no doubt about it, but we'll keep on pursuing. One more, Dr. Bajwa, Dr. Rajan.
Dr. Rajan. Dr. Rajan.
Advani is raised his hand for the time.
Dr. Rajan.
Dr. Rajan.
Yeah, sir. Hi, sir. Sir, this is Dr. Rajan from Kerala, Calicut. Okay, sir. I am into this group and it's a really nice discussion. Not only this, earlier discussions, earlier all the messages are good. As correctly pointed out, Dr. Ajay told, sir, suppose for example, 325 people attended here. How many of us are going to manage our funds individually with all these kind of expert knowledge? So it will be very few who will be following on the matters exactly during the working hours and doing things and all. Let it be a market or let it be a mutual fund or let it be an PPF or whatever it is actually. So what basically I feel is, as Dr. Ajay sir correctly pointed it out, there should be some practical things. So most of us, forget about me, I'm not doing it. Most of the doctors or most of the wealthy people depend on some financial assistance. Let it be a chartered accountant or somebody else, a broker, or they are just entrusting them and giving the money to invest and do things and all. That is what exactly happening in the present trend in the present world, actually, if I'm right, actually. So my suggestion is, see, it is but I'm suggesting it is very difficult. I very well know that there are a lot of confrontations. It was being taken up in the stocks groups of ISA, as well as it has been taken up in the CRISP group and in the financial group also. My suggestion is to just to form some amount of an organization from our IMA or ISA or IAP or whatever it is, and to collect and do services for it actually at a nominal rate. Is it possible to do it? It is definitely, it is a tough job, and it carries lots and lots of risks, and definitely it will be a highly debatable one actually. But if there is a possibility, why can't we think about it? Yes, Dr. Ajay sir, as well as Dr. Virendra, Dr. Chindan Bhai, yes, we all know that actually it's been already discussed. So is there a possibility? Can we go ahead like that?
I have a suggestion.
I will answer that. I will answer that. See, Dr. Rajan, there are many organizations, many groups where you can get the knowledge, but having on the basis of ISA as such, it will be a full of conflicts, full of controversies. It will, because our association is basically the academic part, and the financial part is just a reflection of one of the part of the ISA. So it will be detrimental for the ISA to have a particular group where we can give advices or on a daily to day basis or whatever the financial basis or paid basis, because it will tarnish the image if anything goes wrong of the academic organization. So as a
I have
part
a
of that,
suggestion.
I will try to say that let it be a little bit of more on an individual side rather than entirely on the based on one organization, which is more of academic organization.
Actually, Dr. Bajwa, see,
I have a
our
suggestion. Dr. Virendra, can I say
yeah,
something?
please.
Yeah, the members who are uncomfortable with handling the logistics and things like that, they can rather go for a regular plans instead of direct plans. And I mean, like the logistics will be handled by the distributor.
Yeah, actually, that is what I was coming to. The thing is, see, right from day one, Dr. Khurana sir or Kumre sir and Gadjar sir, they all know our strategy has been that we will answer all your queries. We will teach you, we will try to make you self-competent, but we will not recommend which fund to buy. Similar thing is applies to even in stocks. See, it's a day-to-day. So I was specifically asked by the secretary at that time, don't write the ISA name here. See, whenever money matters are involved, I don't want any of the experts to be blamed later on by naming these schemes and all. So till the time, whatever queries, whatever knowledge sharing is there, we will continue our efforts. But directly getting involved into this. And of course, there are now many financial advisors available. If you don't want to go direct, go through regular one. There is no harm. But because this thought came process in a stocks group that why don't we form a company? And more than 100 members, they said we will contribute more than 1 to 5 lakhs. But then Dr. Chintan said, who will take the burden? Managing, say, suppose 10 crores or 20 crores is a big responsibility. So later on, it was decided we are not going to form any company or something like that. So that was the thought process of our experts I wanted to share. Dr. Kumre sir is running a financial company. Those from South India, they can contact him.
Sir, I have one question.
Yeah.
So at the age of 70, I am running 70. 80% of my investment is in direct equities, and say 15% is in PPF, and hardly 10% in mutual fund. Should I rebalance it, or how can I?
You should, sir. You should. At 80 years, we don't recommend. Or else, if you have sufficient money, think of transferring this money to your next generation, these stocks. If you need money, then you should control it. If you don't need money, let it grow and give it to next generation. Because 70, 80 years is...
That is why I am not rebalancing. It will
if you don't need money, give it to next generation.
Yeah.
They will keep on remembering you, sir. There are examples that my father 30 years back bought some shares of L&T or maybe ITC. Today they are huge. So if you don't need, let it grow and give it to your next generation.
Thank you.
Current close.
I think it's 5:40, 4:45. Shall we close it now?
Yes. Thank
So
you.
I think
Thank
thank
you
you
very much,
everyone
sir.
for joining the session today. And it's a wonderful, and the recording will be available at YouTube at ISN HQ. So you can see the recording immediately within 5 minutes after
Thank you,
the
sir.
session is over, and you can share the link from there to everyone. And we always are very, very keen to learn from the financial experts. We will soon be having a next webinar as soon as we get a time to establish the time for the next webinar on the financial. I think till
Yeah.
then, thank you everyone.
Thank you.
And
Thank you.
we always end by saying, long live ISA.